Give us 30 minutes each week to discover the trends that are shaping the future of retirement with That Annuity Show. We bring you conversations with industry leaders who are revolutionizing financial products, technology, and distribution channels. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Bruno, good to see you.
Good to see you. Good morning, Paul.
All right, excellent. Ramsey, glad to have you as co-host as usual. Well, listen, we've got another great episode of That Annuity Show. Today's episode is about our favorite topic: reaching more people in the annuity industry with our products. Today, we're joined by Reddy, a distinguished leader in the retirement and income solutions space. He's Senior Vice President at Principal Financial Group. He oversees their $1 trillion trust and custody business, along with retail annuity and pension risk transfer solutions, which is that is just a topic we hear so much about today. But beyond the business, he's also a very active advocate for retirement security. He's worked across a number of financial institutions, and he is actually both on the ERISA Council at the U.S. Department of Labor, and he sits on the boards of both the Employee Benefit Research Institute and the Insured Retirement Institute. And I have to say, he speaks at a lot of conferences all around the world, including Las Vegas. And Sri, I want to thank you again for coming out to Las Vegas with us early this year. Welcome.
Yeah, Paul, thank you so much for having me. Ramsey, Bruno, good morning. Thank you all. It's a pleasure to be here. Just one quick edit on your intro, Paul. I was on the ERISA Advisory Council from 2017 till 2019.
Oh, okay.
No longer
Excellent.
after my 3-year assignment, but it was a wonderful experience as well with the Department of Labor.
Okay. Now, that must have been right at the time the Secure Act was passed. Is that the window, or it was in formulation, or?
It helped with the Secure Act, right? Because December of 2019 is when Secure 1.0 passed, with implementation starting right before COVID. While the timing was unfortunate, I've got to applaud both chambers of Congress and all of our legislative partners that made that happen, because advancements in anything that make retirement security more prominent, I think is useful for Americans broadly.
Yeah, well, just to lead off, maybe you could just talk to us about the 4 parts of income solution, because you're responsible for a number of different areas with slightly different focuses on how you deliver income solutions. Do you mind maybe just doing a sort of walk through the business lines and your responsibilities and what's happening in these spaces?
Yeah, happy to. Just for the benefit of your listenership, let's maybe spend 30 seconds on Principal Financial Group. We will be 145 years old here. Actually, we are 145 years old as of July of this year. Coming up, we are in 83 countries, and we're about 20,000 employees. So we're a Fortune 250 that's in a number of arenas. But all of our business come down to 3 things that we do. We provide retirement income solutions. We provide asset management with a focus that started in retirement income solutions. And we provide benefits and protection through the work site. That's it. So no matter where you see Principal around the world, that's the 3 lines of businesses. Now, within that realm, my focus arena, I've got a few businesses I'm responsible for. And it's an interesting mix. And I'll tell you why it gives you a different perspective on how you challenge both the retirement and retirement income problem. I oversee, first and foremost, a bank. So Principal has the largest domicile bank in Iowa. We are one of the top 5% national banks in the country, as measured by assets. Banks are a really important foundational staple for most people, specifically in developed economies and certainly in America, because people understand FDIC protection, they understand guarantees. And you can see how risk averseness takes over versus reward seeking based on the decisions that people make through their banking relationship. So that's the first business I oversee. The second one that we have here is our retail annuity franchise. And the reason retail annuities are really important, at least from my purview, Paul, is when you look at the plethora of demand out there, the number of advisors that use these solutions, the number of consumers that happily embrace them, because they've learned a long time ago what a lot of academics and other maybe pundits in the industry haven't learned yet, which isn't the greatest return isn't what maximizes my happiness. It's ability to be as stress-free as possible, mitigate my worries, and enjoy the time I'm on the planet with the fruits of my labor. And that's a very different problem to optimize than how do I make the highest return possible for the unit risk trade-off. And I say this as someone who started as a buy-side analyst in this industry for a hedge fund 25 years ago, right? So it's a very different perspective than what I have in insurance today. So from retail annuities, an adjacent business I have, and you talked about it, is a pension risk transfer business. Effectively, in retail annuities, we take on the risks of reinvestment, longevity, and interest rate risks, and we put it onto the insurer's balance sheet because we know individual Americans can't bear that risk. You know what? Institutions find those risks really problematic as well. So in the pension risk transfer landscape, we take on those institutional risks that institutions are not comfortable managing. And oh, by the way, we're able to do it because of the insurance company balance sheet, the large pool of mortality and longevity balances we have on the books because of life insurance, and other built-in structural advantages. Adjacent to the PRT business, we have our defined benefit business. Now, defined benefit, we are a leader in the defined benefit space. We have hundreds of thousands of customers in that arena where we manage both the pension benefits and the pension payments. Now, I've got to tell you, it gives you a lot of really rich data into elections, into utilization, into all the behaviors that actually inform our PRT business, which also validate what we learn and see on our retail annuity business. And the last business I'm going to end with, that's within my portfolio that you actually led with, is our trust and custody business. We are a $1 trillion custodian in the marketplace. I think we're a top 10 custodian for sure. I believe our number is number 7 at the moment. But within the trust and custody business, we protect and we execute on long-term promises on behalf of our client. It's no different than the rest of the insurance businesses, but it may not have an explicit guarantee. For the benefit of the listeners on this podcast, one data point that's useful is I have hundreds of thousands of people and lives in my custody business. I make pension payments on as well monthly, which also gives me another rich basket of data beyond DB, PRT, and retail annuities. So I hope that helps as an overview.
That's great, Sri. I had a quick question. You talked about your PRT business and your DB business, and it does give you like a great deal of insight into the traditional retirement income space, which is very important. One of the things we've seen in the last year has been a lot of agitation from labor about getting their defined benefit pension plans back. So we saw that with the UAW last year. They didn't get their DB back, but they said quite openly they're going to come back for it in 2028. And most recently, the Boeing union, the machinist union, rejected a proposal on the basis that it didn't have sufficient. There weren't sort of sufficient things put in place that would be in line with the defined benefit pension plan they once had. So I'm curious. I'm curious where you see the opportunity, given the skill sets and the assets you have, to kind of help bridge that gap.
Yeah, no, I appreciate that, and it's a great question, Ramsey, because you're seeing it there. You're seeing some of the match differences that IBM executed last year. So there are some re-emergences of DB-like features into DC. That being said, let's talk about why DB plans sort of the popularity reduced over time, and why you don't necessarily see new formation of traditional DB plans, but you do see cash balance DB plans that are formed still today. Let's go back to when DB plans made sense for employers to offer. And I talk about this a lot. Until the Industrial Revolution, this concept of a career path, work path, doing the same thing for a number of years, becoming specialized, and having a period of time where you didn't work was fairly novel. So post-Industrial Revolution, what ended up happening was the idea of a pension made a ton of sense, because most of the jobs in society were physically labor-intensive. And with physically labor-intensive jobs, while there is a ramp-up of a learning curve and how efficient and productive you can become, over time you start to have diminishing returns on your physical labor output because we're all human. And right, and aging, unfortunately, while we don't like to admit it, slows us down, sometimes reduces capabilities that we might have had at our prime. So this notion that as people aged in an industrial society that used physical labor, you help them retire, and they typically are in retirement 5 to 7, maybe 10 years, because the longevity wasn't that high, was a great pact for employers, society, future generations of workers, and the workers themselves. The problem that you run into in the society that we live in today is we're very much in one that is shaped by knowledge work. And we know that when you're not necessarily using your physical labor as much, the marginal diminishing capacity I talked about may not affect your ability to be productive and add value to others, which is the essence of what work is. We do it for a paycheck, but when you're getting paid because you're actually adding value to others. So the first question that came up is, how long will people keep working? And can you predict that if you're an employer? The second question was, hey, every year since 1900, we've seen life expectancy improve. It was first dramatic because we eradicated lots of infant mortality. But since then, we've had lots of progress. I mean, one of the more stunning research topics I have spent time studying this year is think of all the GLP-1s. It's estimated to add between 6 months and 5 years of life expectancy, depending on what strata of being overweight or obese you were before you started taking the drugs. That is a remarkable improvement of life expectancy in terms of human scale, just in the matter of the last several years. And this is just getting started. So the increasing longevity made it difficult for employers. The third item was what we're about to start seeing again. Lower interest rates and sustained low interest rates with sustained market volatility makes it really problematic. So those are reasons employers went away from DB plans. Then you add the macro cycle of employees want a choice. So do I need to stay with the employer 30 years? Does that make sense? Or can I move every 3 to 5 years? Now, I think those are the reasons that pension plans went away. The reason you're seeing the demand for it from unions and others, it took away all the insecurity. It took away the inflation risk. It took away the outliving your money risk. It took away doing it yourself risk, which is great. But now you're sitting in this block zone where it's not comfortable for employees. It's not necessarily comfortable for employers. So I think there's a void that the financial services industry can help step in to solve portions of. I don't know if we can do it all, but there's definitely portions we can address.
Yeah, I think it goes without saying. For all the reasons that you mentioned, quite articulately, like there are a lot of reasons why the economics of DB plans simply won't work going forward. But I think that we have to bridge the gap. There are a lot of different ways to do it, but I think we have to bridge the gap, and this industry is in a good position to be able to do that.
No, and one of the things I joke around with, especially when I meet some more hardcore asset management folks who are just like, why do you need protection? People can do this on their own. Best efforts is good enough. Like, go meet someone who's a pension recipient and see how happy they are. The minute you meet a few of these people, you'll realize why it actually makes a difference.
On that topic, we've had a few years ago, we had Doug Orchard, who produced the baby boomer dilemma, in which he interviewed a bunch of Nobel Prize winners who all said the exact same thing that you mentioned. And that goes back to your comment earlier on the return, which I believe should be the tagline for this show. But my question to you is, how do you overcome that issue, that fear that people are so risk averse to any type of risk pooling arrangement that they would not seek that arrangement for themselves? But when it's offered through an employer, then that is the most important thing that they have in the world. So there's definitely an economic cost to that. There's definitely a price for that. We all know that Principal has that ability to price, offer, and guarantee that, along with other firms out there. Why, in your view, why is there so much reluctance from the consumer, from agents, from the entire financial ecosystem to offer some sort of longevity / lifetime income solutions?
Well, it's a great question, Bruno, and I think you're hitting on the fact we're human, right? What makes us humans beyond the id and the ego? We're a stockpile full of emotions, and different people react to different emotions differently. But truth of the matter is, the reason people like pension plans is for all of the things I talked about. Let me tell you why they don't like them. They don't like them when they believe they're setting aside their money for them, and they lose control, and they lose ability to access it, and they believe it's going to be forfeited at some point. Those are the reasons people don't like it. But when an employer's paying for it, they love it, right? Because they think of it as a no-cost trade. Same thing with Social Security. It's that one they're paying for with their employer, but you don't have the option of can you opt out. So in that case, they actually go along with it as well. But for most human beings, delayed gratification is a really hard concept. And you put the human psyche and emotion over that, even with pension plans, for all the people that love it, think about the number of people that take a cash balance option when it's offered. That doesn't matter based on education, tenure, seniority, awareness. None of those things seem to matter. People generally miscalculate their expected life expectancy. They assume too short when they're planning for planning purposes, and they assume their withdrawal amount will last longer than it will because there's optimism baked in there. And how you overcome that beyond education, awareness, and hand-to-hand combat, I think we're still trying to solve it. But you got to make it simple. You got to design. I mean, just like anything with choice architecture, right? I joke around. There's a reason that whenever you go to a buffet, the salads are always at the front. If they weren't, people like me may never pick up a piece of lettuce, and that's why it's there. And how do you figure that out in financial services?
Yeah, and it's true. We talk a lot about education, but I guess to what extent will product designs, continue to drive the market? I know you just launched a RILA early this year. Now is that and I look at those RILAs and kind of ask myself, is it really a new product, or is it a new product that fits the needs of a particular distribution channel who can then go out and explain this thing more confidently to people? How do you look at RILAs, and is this growing the pie, or is it kind of moving the pieces so that we can adjust to some of the changes in the marketplace?
Yeah, so I think RILAs have taken off, and look, the 100 billion of sales that they're going to get to this year is a testament to it. They've taken off quite simply for a couple of reasons. I think people realize when you have markets that are going up, they're sitting at record highs, that they probably should participate, right? We all know that. But when the markets are as high as they are, you've got individual companies that pop 20% on Friday because they had 2% earnings or revenue growth reported on Thursday. You sit there wondering how rational are these markets? Should I still be in them? How do you know you've hit the top? But nobody knows. That's the beauty of the world we're in. And if you don't know, but you know you got to participate, but you're scared of it, because when you're at the peak, downside looks way worse than the upside. Because when you look up, you don't see anything. When you look down, you see lots of ways to go down. I think RILAs address some of those things, right, in a very elegant fashion. They say, look, you're going to forgo liquidity if you're willing to lock up your money and you're willing to take on the credit risk of whoever you're buying this RILA from. They're going to manage the underlying financial engineering to help generate the returns of the equity markets. In return, you'll get some downside protection, but not all, but you'll get some. But you'll also get upside protection depending on the variation you choose. And like most things in life, I think people understand personal deductibles. So the fact that you can pick how much you're willing to lose in return for how much upside you want, or the trade-off, is no different than the decisions you make in your homeowner's plan, your health insurance, or anything else. I think it's simple. And then we also look at the fact it's all done through general account yield and through a guarantee. So there's no question of what fees am I paying, regardless if the market goes up or down, and do I have some level of certainty I can bet on. So I think the product design for RILAs, I think, have been really useful to informing us on what else can we create that helps get emotions out of the way so consumers can do the best thing that's right for them, either directly or with the help of an advisor.
Yeah, and then just sort of one follow-up on this, and you sort of alluded to interest rates, having a very big macro impact on the marketplace. How do you think this will play out in 2025, and maybe by sectors? if you have a perspective you could share with us, be great.
Yeah, well, the first rule is we don't know other than I think the entire market pricing and rates are going down, we don't know by how much or when. And by the time you know, it's too late, right? And so it's like the folks who, after the Fed cut rates 50 points, are trying to get the yields that they had in August. Well, it can't happen at this point. What I tell people is don't worry about the directionality of macro factors we can't control. Within annuity pricing, specifically RILA pricing, I look for is there normalcy within spreads and the spread curve. Can we still manufacture something that is of value to end consumers? And can we do it in a meaningful way at scale? Because you have to have access to asset classes and so forth. That being said, I think RILAs will hold up reasonably well. And here's why I believe that. As rates go lower, two things happens. The implied rate in VIX pricing or options pricing that we use to back RILAs also will change and improve, right? They go in line with interest rates. Two, the alternative investment horizon available for most individuals goes away. The 5% sitting in the money market is no longer there. Soon going to be 4 is going to go, 3 is going to go. If you want to keep up with inflation, equity markets once again are your best friend. But to do it, once again, sitting at the top of the market, I think designs like RILA will be useful even in declining interest rate environments. And we've seen them be successful in rising rate environments. So I think they could be evergreen solutions.
I mean, RILAs have had, a remarkable run. I remember when they first came out, and essentially they had two roles. One is a specific sort of investment role for the end consumer, but they also had very sort of favorable characteristics for the general account risk exposure of companies that had previously been in variable annuities. And at the time, I remember thinking, well, this is kind of feels more like a fixed indexed annuity. It's treated like a VA legally, and I wasn't quite sure exactly where it was going to go, but the very, very consistent growth in them has been remarkable. And again, this notion that like you don't necessarily have to have full principal protection for something to work has been interesting. And because it's a registered product, you're opening up different distribution channels that wouldn't otherwise sell this sort of risk profile to end consumers. So I think it's I've been amazed at the continued success, and I think you're right. I think that in a declining interest rate environment, I can see why that would continue. Sure.
Wholeheartedly agree.
So maybe we can talk a little bit about some of the other areas that you're involved in. So sort of going back to PRT, like what's and actually maybe explain it a little bit further for the audience. Not everybody might know what it is. And where do you think are the growth prospects there going forward?
Yeah, I appreciate the question, Ramsey. So for those who are listening, the acronym PRT just stands for Pension Risk Transfer. Excuse me. And as the name implies, it is when a plan sponsor who has a pension obligation wants to defease that risk from their balance sheet and transfer it to an insurer who can take on the future obligations. There are a few things driving the PRT marketplace. First and foremost, pension obligations in this country, depending on source, I'm going to exclude public pensions here, so those are funded private pension obligations, are between $2.4 and $3 trillion. So it's a big number. And to size that to folks, DC plans are roughly about 9 to 10 trillion, depending on where the market's at.
As an audio footnote, that number for the defined contribution assets under management comes from the Pensions and Investments Annual Survey of DC Retirement Plan Asset Managers as of the end of 2023.
So it's a good portion of the DC plan marketplace that's controlled by plan sponsors, and a good portion of the pension plans that are out there are frozen. What a frozen pension plan means is it's either not available to new participants or it is not available for accretion for growth for existing participants. Once a pension plan is frozen, for a plan sponsor, it is effectively a future obligation, and there's 2 or 3 things that could change the amount of their obligation if they don't have it immunized. If they're invested in equity markets, depending on if the markets go up or down, They may have shortfalls or gains that they have to, if it's a shortfall, they have to make up for it. If it's a gain, they can't really do much with it without tax consequences. If there are interest rates movements and they're not fully immunized from a fixed income standpoint, that could cause funding shortfalls or exacerbations of overfunding. And the third is improvements in longevity. So going back to what I said about the GLP-1s, no one knows where this is going. If you're a pension plan sponsor who thinks you have an effective 10-year life expectancy on your book, but 5 years from now, diabetes is cured, cancer is cured, and being overweight is cured, that's going to change your horizon quite a bit, which has sparked the interest in how do I get this off our balance sheet onto someone else who can manage these kind of risks. So the pension risk transfer market has been around for well over a dozen years now in a significant way. It's been around for a long time. I think we had our first PRT contract on the books decades ago before it was ever called that, when an employer came to us and said, can you help us with this? In today's marketplace, we are transacting, we, the industry, not principal, does between $25 and $50 billion of PRT deals a year. Is that sizable? Well, it's roughly 1 to 2% of the overall available assets. So it's meaningful, but I wouldn't say it is moving the pension market to de-risking anytime soon, but it's going to happen over a number of years and possibly decades. Within this marketplace, there's a couple of interesting things that are happening at the moment. Pension plans, if you look at the data that's out there, and funding levels improve from almost being 85 to 90 cents on the dollar of obligations to they're almost 105 to 107% funded today, which means they actually have more money on the books than they probably need based on where interest rates are and life expectancy is today. Which tells you if you're a plan sponsor and you're a frozen plan, this is probably a great time to get the plan assets off your books without it costing you any money. So no check writing or no more funding the plan, and never having to worry about the volatility it'll create to your accounting or earning stream in out years, or what will happen to mortality changes, interest rate changes, and so forth. But there is, I will tell you, this is not to scare anyone on the listenership, there is finite capacity, both in terms of deal volume, the sheer number of deals the industry can absorb, and the capital to back these things. The $25 to $50 billion mark of deal transfers is probably right. So if you have a client, or if you are a plan sponsor with a pension plan that's at a healthy funding level, this is a wonderful time to think about, how do I insulate it? Do I begin the process? Because these things take 12 to 18 months to effectuate. And what are my options? And if you don't know how, reaching out to a pension consultant or an actuarial consulting firm or your advisor is a great place to start.
So I want to double click just a quick moment on that, because sort of in the early days of pension risk transfer, there were some really sort of big high profile transactions, General Motors and some others. So it started out sort of in the big plan space, but I think that, in conversations I've had with you, this is a solution that actually is potential for has potential for companies of all sizes or many sizes and different sort of scale of plans. Can you talk about that a little bit?
Yeah, happy to, Ramsey. So what's interesting is you're absolutely right. The market started off by transactions that were 25 billion, 8 billion in size, and so forth, because jumbo plan sponsors or large Fortune 100 companies that have these obligations realized that the economic and accounting noise and volatility was causing for them was causing all sorts of distraction from managing their regular business. So that's where this started. But let's be very clear, those type of plan sponsors are incredibly sophisticated. They typically have their own actuaries on the books. They have their own risk management folks, their own investment management teams. And they made the decision, this is too hard. What we've seen since then is a growing awareness for smaller and mid-sized employers. Hey, this probably doesn't make sense for us either. And when we looked at in the past, we would have had to write a fairly sizable check to get out. It looks like we can immunize it today, take the risk off the table, and at some point do the risk transfer. And this is better for our business and potentially even better for our retirees and former employees, because now they're getting an obligation that's secure with someone who is in the business of taking care of pensioners. So I think that awareness is absolutely growing. We write PRT deals. If you're an existing DB client, we'll go as low as, I mean, to whatever your plan size is. We will go into the $1 billion range as well for PRT deals. So we see the whole gamut. And while the sophistication and awareness may be different, the needs and the impact of pension plan obligations are almost the same. And they may even be exacerbated for smaller employers because they're not necessarily aware of all the lingering risks.
So Sri, maybe I'll expose my ignorance on the topic here. But as we're approaching election year, and we won't talk about the elections. I don't want to hear about them. We're getting blanketed with ads. So a lot of the issues at a local level are high tax rates are driven by either healthcare costs as a result of benefit programs for retired employees, or it's the pension itself, or they haven't states or cities or municipalities haven't dealt with the pensions. Does the pension risk transfer business we see open any doors for some of the communities to solve their pension funding problems?
It's potentially a venue, Paul, but for public organizations, public entities, here's a harder rub. Many of them have an obligation, but they're not funded obligations. So it's a notional accounting treatment, and they're holding a value that they know they have to pay in the future. But because they collect tax revenues every year and they make payments every year, they're not necessarily setting aside money for it. There are municipalities, governmental entities that do, but not all. And the vast majority of public pension obligations are unfunded. So asking them to come up with a fairly large check to create something like this, I think is it's going to be onerous for sure. And I don't know if you're going to be able to get public officials take that kind of action. That's one. Two, more than likely, based on some of the amounts, you're probably going to need taxpayer votes or approval to do some of these things, depending on the jurisdiction. I don't know how easily you're going to be able to secure that either.
Well, so interesting. Thank you. Yeah, sure. It's a we have a lot of challenges in front of us. Bruno, go ahead.
Well, shifting gears here, I'm just very curious how because we've been through a lot of topics like liquidity, longevity, and various asset class and the risk returns that are offered there. What are some of the things you principal agents and retirees and pre-retirees can do to address those? And what are the simple options or platforms that are available to them to address those?
Yeah, and Bruno, you asked about a few different risks. I'm going to focus on longevity risk because the interest rate risk, market risk, those aren't necessarily things you can address as an individual or as an advisor, right? Those are things that you can hopefully prepare for, and I'll talk about them in a second. But let me tell you why I'm going to focus on longevity risk first. For the most people, the biggest rub when it comes to predicting how much you need to save is you don't know how long you or your partner, if you're in a relationship, will live to. That creates unfortunate downside tail scenarios where you have to oversave and immunize and protect yourself against. There's a few ways you can reduce that longevity exposure. The first and simplest way that I talk about with people, excuse me, is delay Social Security to whatever age you can reasonably afford. And if you and your spouse or your partner can delay till you're 70 and a half, wonderful. I think that's the single best way for most people. I'm talking about in averages here, keeping up with inflation and having money that actually addresses longevity you can't outlive. A second component would be pension plans. Most of the people who are retiring today, that's the boomers, right? The wave of boomers that retired in the last 20 years or so, including this past year, they probably were covered by some type of pension plan somewhere among their employers. Not everybody, and it depends on industry and so forth, but many do. Before you elect to take your pension plan early, which lots of people do, consider looking at what the impact of delayed claiming strategies there are, as well as what the claiming strategies look like for single and joint income and so forth, and if there's ways you can fill the gap in between. Those two simple techniques on longevity, I think, will help most people out of the gate. A third one, which I think is a really powerful one, but I think fewer people will take advantage of this just because of the whole liquidity control things I talked about earlier, is deferred immediate annuities are a wonderful way of managing this risk. So if you say, look, I'm 65, we've got longevity in my family, but some people go at 70, some people go at 100. I don't know what to do. Well, you can buy an immediate annuity that starts paying out at age 85. And the sooner you buy it, the more cost effective it's going to be. And it's going to be something that you know will always be there starting at age 85 if you need it. So now your planning horizon doesn't say, well, I have to make my money last forever. You only have to make it last for 20 years or whatever the number is to get you to that point. That's a number that's much more solvable for most individuals and financial advisors to work with. So that's a longevity piece. Truly, on the interest rate and equity market piece, you can tell people work longer, save more, consume less. Most people, I don't think, will like any of those three answers. What I tell them is, or you can just worry about things a little bit less and know that there's one other factor you don't read about a lot, but that seems to help human beings throughout time. That's resiliency. Most human beings figure out as times get leaner or times get richer how to expand and shrink their pool of purchases and adjust accordingly. If you don't want to make those choices, take some more of the risk off the table by buying an immediate annuity, whether it's a RILA, whether it's a VA, or other guaranteed sources, to create a structure of income so all of your discretionary and non-discretionary needs that you want to cover are met. But those are basically the ways people have to think about it. There is no free lunch. I can't create wealth out of nothing, and I can't protect tail scenarios if you're not willing to pay for it out of the gate with some level of contribution.
Yeah. Well, sorry, we're almost to the end of our time with you. Thank you for spending time here. I know that you're also on the board of the Employee Benefit Research Institute. Great organization. Is there any recent research, upcoming research that you would want to talk about or tell people to take a look at?
Yeah, for those who don't know, EBRI, or Employee Benefits Research Institute, they've been around since almost the passage of ERISA, and they have some wonderful databases that they track across providers, which provides incredible insights. They actually track individuals, both the wealth and health side, and they look at what their wealth accumulation and depletion patterns are and what their behaviors of healthcare spending are, both getting up to and into retirement. One of the insights I talk about a lot, Paul, and I would welcome people going on to eBreed's website. A lot of their research is available for free. It is a nonpartisan group. It's a non-policy making group. They don't lobby. All they do is put out research. But one of the data points that I think is really important for people to understand is most retirees, almost all, and I don't want to say all, but virtually almost all retirees, end up with more money into retirement a few years in than they started with. The reason I use that stat is when you don't know how much you can take out or how long you're going to live and the paycheck starts coming, most human beings tighten up more than you think and they go into underspending mode, which ironically creates other problems. You're creating a legacy issue, too much of a wealth transfer issue. You're probably not maximizing society's output because we're underspending and not consuming what you actually need. And you're probably taking less risk on the assets you have because you're afraid you're going to run out, which means you're probably actually leaving a lesser bequest because you're not letting it grow to its fullest potential. So data like that, I think, is really important to put in the hands of both advisors, individuals, employers, but also policymakers, because things like annuities really do add substantial value. I'm a guy that started, and look, my background, we didn't talk about this, but I was a management consultant, turned to asset management side, spent time in banking, retirement, then got into annuities at the middle way through my career. And I probably love this product solution more than most because I think it helps human beings get out of their own way and solves for the emotional challenge, which is the hardest one to solve for.
Well, thank you very much. Bruno, any last thoughts or question for Sri?
No, I think this, going back to your point on longevity, well taken. I think that makes perfect sense, and that is a major focus for people and advisors. So thanks for coming.
Shrey, it's great to see you again. We chat every now and again, and we share many common interests. So it's always great to hear your insights on this space across several really important facets. So thank you for that.
Yeah, Paul, Ramsey, and Bruno, and Paul, I'll let you end for sure. But thank you all for having me. This is a really important topic. As you can see, it is near and dear to my heart. I think this is one of the asset classes that people should absolutely consider. If you don't want it after considering it, great. But you should be aware of it, know how it works, and take advantage of it, because I think you'll have a better outcome if you do. So thank you so much for your time. Thank you for all of those who listened, and thanks for having me on.
Sri, thanks so much. And you took the close from me. If you like the show, share it. And but most importantly, be sure to tune in again next week for another great episode of That Annuity Show. Thanks.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Spotify, or wherever you get your podcasts. You can also get more information or listen to more episodes at thatannuityshow.com. Nassau Financial Group is always working harder to be your carrier of choice. We build products that help protect people's savings and are dedicated to providing you with best-in-class service. We seek to keep things simple and have your back in the years to come. Nassau is headquartered in Hartford, Connecticut. Learn more at nfg.com.
Zinnia, an Eldridge Industries business, simplifies insurance. It delivers comprehensive solutions for the industry's most critical needs and creates the modern rails of the insurance industry. To learn more about Zinnia, please visit zinnia.com. And we have a few disclosures from Principal that are important to take note of. Principal Custody Solutions assets under administration were nearly $1 trillion as of December 31st, 2023. Now, before investing in registered index-linked annuities, investors should carefully consider the investment objectives, risks, charges, and expenses of the contract and underlying investment options. This and other information is contained in the free prospectus, which can be obtained from your local representative or online at principal.com. Please read the prospectus and, if available, the summary prospectus carefully before investing. Please note, investment and insurance products are, number one, not insured by the FDIC or any federal government agency. Number two, not a deposit or other obligation of or guaranteed by Principal Bank or any bank affiliate. Third, subject to investment risks and including possible loss of the principal amount invested. Registered index-linked annuities do not directly participate in any stock, equity investment, or index. It is not possible to invest directly in an index. Investing involves risk, including the possible loss of principal. Some important considerations. Index-linked deferred annuity contracts are complex insurance and investment vehicles. This contract is a security, and there is a risk of substantial loss of principal and earnings. The risk of loss may be greater when early withdrawals are taken due to any charges and adjustments applied to such withdrawals. These charges and adjustments may result in loss even when the value of a segment option has increased. Clients should consult with a financial professional about the appropriateness of this product based on their financial situation and objectives. There is a risk that this segment interim value could be less than the original premium payment, even if the applicable index has been performing positively. The buffer or floor rate provides limited protection. There is a possibility of a significant amount of loss of the total premium payment, credited interest, and prior earnings. In the index-linked segment options, it is possible that the total loss could be 100%. If clients choose to allocate amounts to index-linked segment option subject to a cap rate, that rate limits the positive index change, if any, that may be credited to the annuity for a given segment term. The participation rate limits the positive index change, if any, that may be credited to the annuity for a given segment term. It is possible to receive less than the full protection of the buffer rate or floor rate. Once a segment lock-in is executed, it is irrevocable for that segment term. A lock-in will not be applied retroactively and can only be exercised for the entire segment option. A segment lock-in may only be exercised once per segment term for each index-linked segment option. There is no guarantee that any particular segment option or index will be available during the entire period. All guarantees and benefits of the insurance policy are backed by the claims paying ability of the issuing insurance company. Policy guarantees and benefits are not obligations of nor backed by the broker-dealer and or insurance agency selling the policy, nor by any of their affiliates, and none of them make any representations or guarantees regarding the claims paying ability of the issuing insurance company. Pension plan assets transferred to an insurance company group annuity contract through a pension risk transfer are guaranteed by the claims paying ability of the issuing insurance company. The subject matter in this communication is educational only and is provided with the understanding that Principal is not a rendering legal, accounting, investment, or tax advice. You should consult with appropriate counsel, financial professionals, and other advisors on all matters pertaining to legal, tax, investment, or accounting obligations and requirements. Employee Benefit Research Institute, EBRI, is not an affiliate of any company of the Principal Financial Group. Annuity products and services are offered through Principal Life Insurance Company. Custody and trust services are provided by Principal Bank, member FDIC, and or Principal Trust Company. These services are provided under the trade name Principal Custody Solutions. Principal Trust Company is a trade name of Delaware Charter Guarantee and Trust Company. Securities offered through Principal Securities, Inc., member SIPC, and or independent broker-dealers. Principal Global Investors leads global asset management. Reference companies are members of the Principal Financial Group, Des Moines, Iowa, 50392, found at principal.com. Annuities have limitations. They are long-term vehicles designed for retirement purposes. Annuities are not intended to fund short-term savings goals. Principal Financial Group, and Principal and the logo mark design are registered trademarks of Principal Financial Services, Inc., a Principal Financial Group company in the United States, and are trademarks and service marks of Principal Financial Services, Inc. in various counties around the world. And we have a legal disclosure number of 3997008-102024.